A quiet shift is happening inside India's economy right now, and most people won't notice it until it's already irreversible. Because after months of chaotic intervention, soundproof trading rooms, and orders to sell $100 million every single minute, the rupee is entering a new era. And here's the part almost nobody wants to say out loud. The rupee is unlikely to return to the kind of strength people remember, not for a very long time. Let me explain why. For years, India pushed toward a dream, a fully convertible rupee, a currency that global investors could hold freely, a financial ecosystem that could compete with the world's biggest markets. But that dream breaks when pressure hits, and today, the pressure is everywhere. The rupee just broke the psychologically critical level of 90 per dollar. Foreign investors are pulling money out. India's trade deficit is widening, and the United States has slapped 50% tariffs on Indian exports. At the same time, the Reserve Bank of India is running one of the most aggressive currency defenses we've seen in a major emerging market. They are draining tens of billions of dollars from reserves. They are sitting on a $64 billion short forward position, and they're fighting speculation offshore, in the round-the-clock non-deliverable forward markets in Singapore and Dubai. The result is simple. India has crossed the line into a policy-managed currency. And once you cross that line, you don't go back quickly. Here's the first reason why. Volatility is now a feature, not a bug. The RBI is intentionally unpredictable. Some days they step in and unload hundreds of millions of dollars. Other days they vanish, letting the market feel the pain. And the point is to keep traders guessing. But when a central bank becomes unpredictable, markets hedge more aggressively. Hedging gets more expensive, currency bands widen, and slowly, the market begins to expect depreciation. Once that expectation is in place, it becomes self-fulfilling. Here's the second reason. Full rupee convertibility is now delayed by years. You cannot open a currency to the world when you're already defending it this aggressively. You cannot commit to free capital flows when you're draining reserves and juggling offshore intervention. Convertibility requires low deficits, predictable policy, deep financial markets, and stable foreign flows. India currently has the opposite, and as a result, the dream of a fully convertible rupee moves from 2030 to something closer to 2035 or beyond. And here's the third reason. The global market is starting to price India the same way it priced Japan, Korea, and eventually China. A strong economy with a structurally weak currency. Not because the economy is fragile, but because policymakers value growth and stability more than a strong exchange rate. India is making the same choice. Protect domestic growth. Protect the banking system. Protect financial stability. Accept that the currency will weaken slowly, year after year. This is exactly what the IMF sees. They recently reclassified India's exchange rate regime as crawl-like. That means controlled depreciation, managed flexibility, and constant behind-the-scenes intervention. So what does the next decade look like? A rupee that doesn't collapse but also doesn't strengthen. A currency that drifts lower in a controlled, predictable way. 3%, 4%, maybe 5% a year. Stable enough to avoid crisis, weak enough to stay competitive, and permanently managed from behind the curtain. That's the real story behind India's currency defense. Not just the soundproof rooms, not just the $100 million sell orders, but the long-term path India has now entered. A path where the rupee can be stable, but unlikely to regain the strength people once expected. Not anytime soon. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.